Welcome to the Pirls Stock Market Commentary video for December 18th, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.53 fell from 1.84 last week, remaining within bullish territory. The total count of securities in bullish or bearish patterns decreased 2%. to 3,189. The count of bearish stocks increased 10%, while the count of stocks in bullish patterns decreased 8%. The Pirls P&F Market Breadth Summary Chart shows us a market now 6 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com. clicking membership, clicking register, and following the prompts. To subscribe to the weekly email version of the Pirls Stock Market Commentary free of charge, simply enter your email address in the space provided and click subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 44 points for the 7th advance in 18 weeks. At a positive 405.81 points, it continues above the November 2014 and March 2015 tops, as well as continuing below all the remaining 2 tops above plus 100, as well as above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 5 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, also on higher average daily volume. Momentum, now at a positive 98.6, down from a positive 141.16 a week ago. The CCI 20 daily at Monday 12/5 close formed a zero-line reject long entry signal inside the plus or minus 50 range. It has dropped below plus 100 for an exit at Monday 12/19 open. We will report the results of this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 33 weeks ago, while the daily CCI 20 began a Woody's uptrend 4 weeks ago. The CCI 20 weekly has risen to 199.98 from a positive 182.53 last week. After last week's successful trade completion, we wait for the CCI 20 weekly to return to the plus or minus 50 range for another potential trade. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and 2 of the bottom 5 are negative. Summary, oil and some tech on top, gold and silver, some tech, retail, and brokers on the bottom. Bullish, gold and silver continues to lead the bottom 5. Semis and comp tech have left the bottom 5 and entered the top 5. Bearish, oil continues in the top 5. KBW Bank has left the top 5. Disk Drives has re-entered the bottom 5. S&P Retail and Brokers have entered the bottom 5. Focus this week from www.realinvestmentadvice.com. Fed's Fantasy versus Reality, 12/16/16. Missed it by that much. The markets came just 30 points shy of hitting the magic number before retracing slightly midweek. As Get Smart used to quip, "Missed it by that much." Seriously, it really was just that close. I still suspect there is enough bullish exuberance currently to push the Dow to 20,000 and the S&P to 2,300 by the end of the year. However, I am more concerned about what happens next. One of the major problems with fundamental and macroeconomic analysis is the psychology of the herd can defy local analysis for quite some time. As Keynes once stated, the markets can remain irrational longer than you can remain solvent. As shown in the chart below, the momentum of the market has decidedly changed for the negative. Furthermore, these changes have only occurred near market peaks in the past. Some of these corrections were more minor, some were extremely negative. Given the current negative divergences in the markets from RSI to momentum, the latter is a rising possibility. In the near term, as we head into holiday-shortened trading weeks, performance chasing and end-of-year window dressing, a push higher is extremely likely. However, given the underlying detachment between sentiment and reality, the risk of a negative surprise has risen sharply. As Bob Farrell's rule number 9 states, when all experts and forecasts agree, something else is bound to happen. And currently, everyone agrees. At the long-run rate of inflation-adjusted earnings growth, it would take about 14 years for the Shiller PE to fall below 20 at current stock prices. That would be par for the course, as it took an average of 15 years for the Dow 100, 1,000, and 10,000 to be visited for the first and last times. Past isn't prologue, but keep those Dow 20,000 hats around. They may come back into fashion around the year 2030. As shown above, the Trump trade has become extremely crowded on expectations about what might occur rather than what has. However, much like we saw in 1999, investors piled into stocks with expectations the market advance would never end. They were horribly wrong. The Fed's dot plot suggests the Fed hopes to hike rates 3 times within the next year. The problem, and as I will dissect in a bit more detail, is the expanse between the Fed's fantasy and economic realities. This is shown in the table below, which documents the median of the Fed's economic projections versus reality. In every single year, they have been wrong. Yet, besides being the world's worst economic forecasters, the market still believes statement made. Employment, job gains averaged nearly 180,000 per month over the past 3 months, maintaining the solid pace that we have seen since the beginning of the year. Over the past 7 years, since the depths of the Great Recession, more than 15 million jobs have been added to the U.S. economy. The unemployment rate fell to 4.6% in November, the lowest level since 2007, prior to the recession. Depending on where you start counting, 15 million jobs may have been added to the U.S. economy. However, there is an important distinction to be made. The actual number of jobs created is 4.77 million fewer than the increase in the working age population, June 2009 to present. Inflation. Core inflation, which excludes energy and food prices that tend to be more volatile than other prices, has risen to 1.75%. As the transitory influences of early declines in energy prices and prices of imports continue to fade, and as the job market strengthens further, we expect overall inflation to rise to 2% over the next couple of years. Here's the problem. The only inflation in the market currently is coming from spiking healthcare costs and rental rates, as shown in the breakdown of Consumer Price Index. It is clear where inflationary pressures have come from over the past 5 months. Economic growth. The median projection for growth of inflation-adjusted gross domestic product rises from 1.9% this year to 2.1% in 2017 and stays close to 2% in 2018 and 19, slightly above its estimated longer run rate. Unfortunately, she will likely be proved wrong once again, as she has been in every year since 2011, as hope is eventually faced with economic realities. First, record levels of anything are records for a reason. It is the point where previous limits were reached. Therefore, when a record level is reached, it is not the beginning, but rather an indication of the maturity of a cycle. While the media has focused on unemployment, record stock market levels, etc., as a sign of ongoing economic recovery, history suggests caution. So, if you are betting on a strong economic recovery to support excessive valuations and extremely stretched markets, you could be setting yourself up for disappointment. Oh, and don't think for a moment that rising interest rates combined with a strongly rising dollar is somehow good for stocks. It isn't. It has never been. Thank you for viewing this week's Santu Pirls Stock Market Commentary, featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive party week coming up. Wishing you Merry Christmas and true success.